Hi, this is Steve Tuttle from Signet Financial Management. I'm going to be presenting some thoughts on some common investor concerns that we're hearing these days from clients. Markets involve risk, and it's quite understandable for investors to feel at times some anxiety, some unease, and a general level of concern for being invested in markets. Unfortunately, some volatility and uncertainty is a necessary function of markets, and I'm going to address three very common issues that we're hearing today. The first has to do with the bull market that we're currently in. It's lasted for more than 8 years, and there's a lot of clients that are expecting a downturn at some point, perhaps imminently. So we look back at history to see if there's any relevance to this conclusion. And one of the things we look at is economic growth. And what we found is that this economic expansion has actually been a very shallow recovery, even though it's been long in terms of duration. In fact, in the U.S. economy, GDP growth has averaged less than 2% per year, or only 18% on a cumulative basis. Compare this to the typical economic expansion, which has been around 35%. And given that difference, it does allow us to believe that there's still some upside to the economic expansion. Another thing we'll point out is that bull markets do not generally end from old age alone. They typically end because of one of several factors, including an overheating economy. The economy is growing too fast. Some type of macro level shock, and a recession. And today, the fundamentals just don't seem to support any of those outcomes. Another question has to do with valuations. Are they too high? And while markets aren't cheap, we do think the fundamental backdrop is still very supportive for higher prices. If you look at profits, they're rising and very strong. Interest rates are still low, and the overall economy is very positive, both in the U.S. and overseas. The other thing I think it's important to consider is that valuations are uneven. The S&P 500 gets all the attention, and it's basically an average of 500 different stocks. That's the valuation level that gets all the attention. But within that index, there are some sectors and stocks that are a little bit more expensively valued because they've done so well. If you look at sectors like information technology and consumer discretionary as an example, as a sector, those areas have done very well. And yes, there are some expensive stocks within those sectors. But if you look at other sectors that haven't done quite as well, such as financials and energy, they've lagged quite a bit. And if you look in those sectors, there may be some opportunities because the valuations aren't nearly as high as the S&P 500. So that's just a small example of how we believe it pays to be selective when valuations start to get stretched. Finally, and this is a very common question or concern that we hear, has to do with investing near market tops. It might seem right to sit on the sidelines or wait for a pullback to invest. The idea is, since markets are so high, why would I invest now? Why don't I wait for things to cool off? So we look back in history to see if there was any credence to that type of investment philosophy. And what we found is quite the opposite, actually. There doesn't seem to be any advantage or disadvantage to investing near market highs. In fact, the study that we're showing here shows that after hitting new highs, markets tend to be even higher 12 months later, more than 80% of the time. That's pretty encouraging. So again, rely on history, be disciplined, and the fact that there is some risk and some concern out there, to us, is an unfortunate part of investing, but it's a necessary part of investing, and it's exactly that type of uncertainty that generates return in the future. So if you have any questions or concerns that I didn't highlight here that you'd like to discuss, please call me or email me. I'd also encourage you to follow us on Twitter at Signet